You know, usually when you talk about a really high failure rate in a specific profession, we kind of just assume it's because, well, the people trying it just aren't smart enough.
Right. That is the standard assumption.
Yeah, or maybe they just don't have the right educational background. Like, if you hear that 95% of people fail at something, your very first thought is probably that it requires some kind of rare, innate genius.
Absolutely. You think it's a talent issue.
Exactly. But imagine a field where 95% of the people who enter it just lose entirely. And I don't just mean they underperform the average. I mean, they lose all their money in their first year.
It's a brutal statistic.
It really is. And the truly mind-bending part about this, the people making up that massive group of consistent losers, they aren't uneducated. They are doctors, they are lawyers, engineers, CEOs.
Highly intelligent people.
Yes. We are talking about incredibly successful people who enter this specific arena and just fail miserably. And so the question is, why?
It's a staggering reality to confront, honestly. It completely upends our fundamental assumptions about how success actually works in the world.
Because we're taught that smarts solve everything.
Exactly. We are taught our entire lives that intelligence, hard work, and just gathering more knowledge will eventually conquer any problem you face. I mean, if you are a surgeon, your intense study and your precision, that keeps your patients alive.
Right.
If you are an engineer, your mastery of physics and mathematics keeps the bridge from collapsing. But in the environment we are analyzing today, those exact traits, like the reliance on deep analysis and the expectation that being right equals success, well, those can actually destroy you.
And we should clarify, we are talking about the financial markets. Specifically, we're going on a deep dive into the psychological framework of trading. And we're drawing heavily from Mark Douglas's seminal work, Trading in the Zone.
It's such a foundational text.
Yeah, it really is. But right off the bat, I want to frame this for you, the listener, because even if you have literally never bought a stock, a future, or a crypto coin in your entire life, you really need to stick around.
Oh, absolutely.
Because while the laboratory we are looking at today is the financial market, this isn't really a deep dive about finance at all.
Far from it. It's really an exploration into the very wiring of our brains. It is about how our natural psychology, the mental software we've been installing and reinforcing since early childhood, actively sabotages us.
Sabotages us when we step into an environment that lacks conventional rules, right?
Exactly. When we lack boundaries. The financial market just happens to be the most ruthless mirror available for reflecting our own psychological flaws right back at us.
Okay, so let's unpack this, because the idea that being highly intelligent and hardworking is somehow a disadvantage, well, that's really hard to swallow. Where do we even begin to understand why traditional, conventional intelligence fails so spectacularly here?
To understand why human psychology is this ultimate undefeated hurdle, we first really need to look at how people have historically tried to beat the market through pure data, and why that data always, inevitably, falls short.
Okay, data failing. Walk us through that.
So for a long time, the dominant method of navigating the markets was something called fundamental analysis. This is the purely logical, mathematical approach. It is exactly the kind of thing an engineer or a doctor would just love.
Right, because it makes sense on paper.
It makes perfect sense on paper. In fundamental analysis, you look at the tangible data. You study interest rates, corporate balance sheets, global weather patterns, supply and demand models.
The hard facts.
Exactly. Take all these concrete variables, you crunch the numbers through sophisticated mathematical models, and the model tells you what the price of a commodity or a stock should be in the future.
It sounds perfectly reasonable. I mean, if a company is making record profits, launching a revolutionary new product, and has virtually zero debt, the stock should logically go up.
Logically, yes.
Or like if you are trading coffee futures and a massive unprecedented freeze destroys half the crop in Brazil, the supply drops, so the price of coffee should logically skyrocket. That is just basic economics.
It is basic economics. But there is a massive structural flaw in fundamental analysis when you apply it to the reality of the trading floor. And this flaw creates what the source material calls a reality gap.
A reality gap.
Yeah. The fatal flaw is this: mathematical models do not move prices. People move prices.
People. The ultimate messy, unpredictable variable.
And that is the crux of it right there.
Yeah.
Prices only move because individual human beings express their beliefs about the future by physically hitting a buy or sell button.
Right. Someone has to take the action.
Exactly. A fundamental model might perfectly, flawlessly predict that coffee should be priced at $5 a pound based on that freeze in Brazil. But if the traders on the floor or the massive institutional algorithms pushing the buttons don't know about that mathematical model, or they simply don't care about it, the price won't reflect the math.
So the math is essentially just sitting in a vacuum.
Precisely. The human beings making the trades are acting on their own fears, their own greed, their immediate emotional reactions to a news headline. Or maybe even just the fact that they're having a bad day and want to close out their positions.
And none of that is in the spreadsheet.
Exactly. All of those human emotions are completely outside the parameters of the mathematical model. If the crowd is panicking, your spreadsheet proving that the stock is undervalued is completely useless.
Wow. So relying on what should logically happen is a recipe for disaster if the crowd is acting on emotion. You could be 100% mathematically correct and still lose all your money because the crowd didn't behave logically.
It's a harsh reality to face.
I imagine that realization was a bitter pill for the financial world to swallow. Which brings us to the late 70s and 80s, right? When a massive paradigm shift happened. People started realizing the math wasn't enough, so they moved to technical analysis.
And this shift fundamentally changed how people looked at opportunity. Technical analysis is essentially the study of collective behavior patterns.
So not the balance sheets anymore.
No, instead of asking what a stock should be worth based on a balance sheet, technical analysts look at a price chart to see what people are actually doing right now.
For you, the listener, who might not be familiar, this is when you start seeing those crazy, complex charts on financial news networks. The ones with the squiggly lines, the red and green candlesticks, the bar graphs that look like an electrocardiogram.
That's the one. And while it looks like complete chaos to an outsider, it's actually a map of human psychology.
A map of psychology, how so?
Well, the market consists of a finite number of traders interacting with each other. Over time, these individuals form collective behavior patterns. Because human psychology, fear, greed, panic, euphoria, it doesn't really change over centuries. So these behavioral patterns repeat themselves on the charts with statistical reliability.
So technical analysis allows you to essentially read the mind of the market. You can look at a chart and say, okay, the last 10 times the price line made this specific M shape, the price plummeted immediately after.
Exactly.
Therefore, because human nature repeats, there is a high probability it will plummet again.
That is the entire premise. You are looking for a visual representation of mass psychology. And as a method for finding opportunities, it is incredibly effective. It turns the market from a confusing random mess into this endless stream of identifiable chances to enrich yourself.
And I know there is a massive but coming, because otherwise those doctors and engineers would just memorize the chart patterns and become billionaires by Tuesday.
There is monumental but.
Yeah.
And it leads to the entire thesis of our deep dive today. Even with perfect, flawless technical analysis, a massive gap exists.
Just psychological gap.
Yes. You have the fundamental gap we just talked about, but now you run into the psychological gap.
I read this part of the source material, and it resonated so deeply, honestly, even outside the context of trading. The psychological gap is the difference between knowing what to do and actually doing it.
It's a huge chasm.
It really is. You can look at a chart, read the pattern perfectly, recognize that the setup is just screaming at you to buy, and say to yourself with absolute certainty, the market is going to go up. And then, well, you do nothing.
You completely freeze.
You sit there completely paralyzed. You watch the market do exactly what you predicted it would do, and you just agonize over all the money you could have made if you had just clicked the mouse.
It's a terrible feeling.
Or conversely, you enter the trade, it goes slightly against you, you completely panic, sell everything at a loss, and then watch the market turn around and skyrocket just like you originally planned.
The disconnect between prediction and execution is profound. Knowing what the market is likely to do is entirely different from having the mental capacity to actually put your money on the line, take the risk, and manage the trade without your nervous system completely freaking out.
That nervous system reaction is intense.
Oh, very. And this specific agony, the agony of knowing you were right but still losing, is where highly intelligent people fall into what the source describes as the black hole of analysis.
The black hole. I want to spend some real time here, because this is where the traditional intelligence of the doctors and engineers actually becomes a weapon turned against them. Walk us through how a smart person gets sucked into this black hole.
Let's look at how we are conditioned to solve problems in the normal world. If you are a medical student and you fail an anatomy test, what is the solution?
You study more.
Exactly. The solution is to study more. You gather more information, you memorize more terms, and you pass the next test. In the conventional world, more knowledge always equals greater safety and greater success.
It's the ultimate linear equation. Effort plus knowledge equals victory.
Right. So our highly intelligent trader enters the market. They use some basic technical analysis, they enter a trade, and they lose money. The loss hurts. It is emotional pain.
Yeah.
So their brain falls back on its default, socially conditioned programming. I lost because I didn't know enough.
So they go back to the books.
They go on an obsessive knowledge quest. They decide basic chart patterns aren't enough. They learn about complex moving averages. They learn about Elliott wave theory.
They just keep piling it on.
They do. They start trying to map human behavior to mathematical Fibonacci sequences found in nature, hoping that geometry will somehow protect them from loss. They acquire an absolute arsenal of analytical tools.
Wait, hold on. I really need to challenge this premise because everything in our society screams the opposite. You're telling me these brilliant people are failing because they are studying too much?
In a way, yes.
But in what universe is learning more about your chosen field a disadvantage? How can acquiring more knowledge about the market actually be a bad thing?
It's a brilliant question, and it's the exact trap they fall into. The problem is not the knowledge itself. Knowledge is neutral. The problem, the poison in the well, so to speak, is the motive behind the learning. Why are they acquiring all this complex data?
Well, to make money, right?
No, that is what they tell themselves. But subconsciously, they aren't learning more about the market to find a systematic way of winning. They are learning more to avoid the emotional pain of being wrong.
Oh.
Yeah. They experience the pain of a loss, and they are now desperately trying to gather enough variables to create a scenario where they can't possibly lose again. They are trying to engineer certainty in an environment where certainty does not exist.
They want an armor made of data. They think if they just cross-reference 20 different indicators, the market can't possibly hurt them.
That's a perfect way to put it. But it's an armor full of holes. Because in trading, you can never, ever learn enough to anticipate every single variable.
Because of the people again.
Exactly. Because you aren't dealing with physics. You're dealing with people. It only takes one trader somewhere in the world with enough money to decide to buy or sell for a completely random reason, to completely negate your perfect, flawless technical analysis.
You can analyze a chart for 20 hours, cross-referencing global trends and Fibonacci spirals, but you can't predict that a billionaire in another time zone is going to wake up in a bad mood, decide he wants to buy a super yacht, and liquidate his entire portfolio.
And that crashes your stock.
Right, crashing the price of your perfectly modeled stock.
You cannot predict the rogue variable. So think about the psychological devastation that follows. Our trader, wrapped in their armor of data, takes a trade. They are absolutely certain they're right because their 20 indicators align perfectly. And then the billionaire liquidates, the market tanks, and the trader loses money again.
The betrayal they must feel.
It was agonizing. So the more you learn solely for the purpose of avoiding pain, the more devastated and frustrated you get when you inevitably lose anyway. It feels deeply unfair.
So what does the intelligent person do then?
They think, well, I guess I still didn't know enough. And they dive back into the black hole looking for a 21st indicator. It's the vicious self-destructive cycle. The more they learn, the more rigid their expectations become.
Which makes the inevitable losses hurt even more.
Precisely. Which compels them to learn even more to try and stop the pain.
It's like quicksand. The harder you struggle to find certainty, the deeper you sink into paralysis. Which brings us to the ultimate realization, the shift from technical analysis to mental analysis.
That's the real turning point.
If studying the market's behavior doesn't work, and studying economic fundamentals doesn't work, then the problem must not be the market. The problem is the environment of trading itself, and how our socially conditioned minds are completely, woefully unprepared to operate within it.
If we logically accept that more market analysis isn't the cure, we have to examine the environment we're stepping into. And trading is uniquely dangerous to the human psyche because it is an environment of absolute, boundaryless freedom.
Let's explore that psychological wilderness, because when you say boundaryless freedom, that sounds amazing.
Yeah.
I mean, most people spend their lives dreaming of freedom. They hate their bosses, they hate the rules, they just want to be free. Why is that dangerous?
To understand the danger, think about how we actually grow up and develop as humans. From the exact moment we're born, society provides structure. Our parents tell us when to eat and when to sleep.
Sure.
Then we go to school, where bells tell us when to sit down and when to leave. We get jobs, where bosses tell us what projects to work on and set deadlines for us to finish them.
There are guardrails everywhere.
Everywhere. Society operates on rules, boundaries, and consequences. We are deeply conditioned to operate within very defined, externally imposed parameters. Even when we rebel against those rules, our rebellion is still defined by the existence of the rules.
But the market doesn't care about any of that.
The market doesn't provide a single ounce of external structure. It gives you unlimited freedom of creative expression. You can buy when you want, you can sell when you want, you can risk $1, or you can risk your entire life savings on a single tick of the chart.
There's nobody stopping you.
Nobody. There are no formal beginnings, middles, or endings to a trade unless you, the trader, actively decide them.
For a mind accustomed to being told what to do, stepping into a space with zero guardrails isn't liberating. It's actually terrifying.
It is existentially terrifying, even if we consciously tell ourselves we want the freedom. To really clarify this danger, the source material uses a fantastic analogy comparing trading to a casino, specifically a game like blackjack.
Let's break that down because most people associate trading with gambling anyway. But there is a crucial structural difference that makes trading infinitely more dangerous than sitting at a blackjack table.
Think about the structure of a casino game. Even in an environment designed to take your money, the game itself has built-in boundaries that protect you from your own psychology to a certain degree. In blackjack, the rules of the game force you to determine your risk before the game even begins.
Right, you literally have to reach into your stack, pull out the chips, and physically push them forward onto the betting circle. If you don't do that, the dealer just moves past you, you don't play.
The game forces you to confront the reality of loss in advance. You look at those chips in the circle, and I might lose this exact amount of money in the next 10 seconds.
Yeah.
But in trading, no one forces you to define your risk.
You can just jump in blindly.
You can enter a trade, click buy, and never put a stop-loss order in place. You can step into an environment where virtually anything can happen without ever deciding in advance what it will cost to find out if your idea is right.
You are leaving the door to your bank account completely wide open. And it gets so much worse because of how the events actually end. In blackjack, the hand has a definitive external ending. The dealer flips the cards, someone wins, someone loses. If you lose, the dealer reaches out, takes your chips, and the event is over.
The structure ends the pain for you.
Yes. And if you want to lose more money, you have to be what the source calls an active loser. You have to physically make the choice to reach back into your pocket, pull out more money, and push it onto the table for the next hand. You have to take a positive action to continue the damage.
But trading has no external ending. And because there is no formal ending, trading allows you to become a passive loser.
The passive loser. This concept gave me chills, honestly, because you see it in so many areas of life, not just finance.
It is the most insidious trap in the boundaryless environment. Once you enter a trade, the market does not take you out of it unless you have the internal mental structure to end it yourself. If a trade starts going against you and you are losing money, you don't have to do a single active thing to keep losing.
You don't have to push more chips forward.
You don't have to do anything at all. You can just freeze. You can stare at the red numbers on the screen. You can close your laptop. You can literally walk away from the computer, go to the kitchen and make a sandwich, and the market will just keep taking your money, bleeding your account dry, and potentially putting you in massive debt while you passively do absolutely nothing.
That is deeply unsettling. You can just be paralyzed into bankruptcy. It relates so perfectly to a business owner who launches a terrible marketing campaign that is bleeding cash, but they refuse to pull the plug because they don't want to admit it was a bad idea. They just passively let the company bleed.
It's the exact same psychology.
So if the environment is this dangerous and the potential for ruin is so high, what fuels the bad behavior? What keeps people coming back, refusing to set boundaries despite the absolute danger?
The psychological fuel for this destruction is the concept of random rewards. And this taps into some fundamental behavioral psychology. Let's look at the classic monkey experiment mentioned in the source material to understand how our dopamine systems are basically hijacked.
I love this experiment. It explains so much about human behavior, from trading to scrolling social media.
It really does. If you put a monkey in a room and teach it to perform a task, say pulling a lever, and you reward it with a treat consistently, every single time it pulls the lever, the monkey learns the linear pattern. Effort equals reward.
Makes total sense.
But if you suddenly cut off the treat supply, the monkey will figure it out very quickly. It will pull the lever a few times, realize the reward is gone, and simply stop doing the task. It won't waste its energy on a dead end.
Because the pattern of consistency was broken, the brain recognizes the change. But the catch is what happens when the reward is completely random.
This is where it gets fascinating. If you put that same monkey on a completely random reward schedule, sometimes it pulls the lever and gets a treat, sometimes it gets nothing, sometimes it has to pull it 20 times to get one treat, and then you stop rewarding it entirely.
What does the monkey do?
The monkey will keep pulling that lever indefinitely.
It will literally pull the lever until it exhausts itself.
Yes, because it never knows for sure that the reward is permanently gone. Every past reward it received came as a surprise. The brain becomes completely addicted to the unpredictability.
If we relate this back to the trader staring at a screen, the market operates exactly like that random reward lever. The danger is that you don't actually have to be good at trading to win.
You really don't.
You can be a terrible analyst, you can completely ignore risk management, you can refuse to use stop losses, you can act like a completely undisciplined gambler, and you can still stumble into a massive life-changing winning trade.
You could do everything wrong and hit the jackpot. And when that happens, the psychological damage is immense. That unexpected windfall releases a massive flood of euphoria-inducing dopamine in the brain. It is highly, deeply addictive.
Because your brain associates the lack of discipline with the massive reward.
Precisely. It teaches your subconscious that you don't actually need discipline, rules, or structure, because a massive random reward could happen at any second, regardless of your behavior. This addiction to the euphoria of random rewards is one of the most powerful sources of resistance to creating the mental structure required for consistent success. Why build a disciplined system when playing the lottery feels this good?
So to survive this boundaryless, highly addictive wellness, the absolute baseline requirement, basically the cost of entry for anyone who wants to stop being a victim, is taking 100% responsibility.
Without a doubt.
The source material emphasizes this repeatedly. The market is a zero-sum game. Its only purpose is to separate you from your money while giving you the opportunity to do the exact same thing to someone else.
You must accept at a cellular level that the market owes you absolutely nothing. It is not there to validate your intelligence, and it is not there to pay your mortgage.
I get that intellectually, but let me speak for the emotional part of the listener's brain right now. It is so deeply, inherently natural to feel betrayed by the market.
Oh, of course it is.
Think about it. You spend hours doing the research, you do the fundamental analysis, you do the technical analysis, you enter the trade, and suddenly, for no logical reason, the market tanks and takes your money. It feels incredibly personal. It feels like the market is actively, maliciously out to get you.
It absolutely feels personal in the moment, but we have to ask why it feels that way. Why do we assign malice to lines on a screen? This taps into some very deep early childhood psychology. When we blame the market, we are essentially regressing to an infantile emotional state.
Walk me through that. How does losing money on a stock make me a toddler?
Think about being a young child playing with a favorite toy. You are entirely absorbed in the moment, experiencing pure joy. Suddenly, an adult walks into the room, rips the toy out of your hands, and tells you it's bedtime.
Ouch.
Right. In that exact fraction of a second, you are thrust from a state of total happiness into a state of absolute powerlessness and emotional pain.
And crucially, I had no control over it. It was an external force acting upon me. It was done to me.
Exactly. The external force, caused your pain. And as adults, when a trade goes wrong and we lose money, it triggers that exact same neural pathway. We feel that instantaneous violent shift from the hope and joy of a winning trade to the agony of a loss, and our deepest, oldest instinct is to blame the external force of the market. We want to scream at the screen the way a toddler screams at a parent.
But the market isn't a parent.
The market doesn't even know you exist. It is a completely neutral entity. It generates information in the form of upticks and downticks. That's it. It has no agenda.
Any degree of blaming the market, any feeling of betrayal, simply means you have not accepted 100% responsibility for your own interpretations and your own actions. If you blame the market, you are giving your power away to an entity that just doesn't care about you.
You're making yourself a victim.
And as long as you remain a victim, you cannot be consistently successful in an environment of infinite choice.
That is the harsh reality. You cannot control the market. You can only control your perception of it and your reaction to it.
Which perfectly transitions us into understanding how we perceive things. Because if we intellectually accept that the market is a neutral stream of data, we still have to deal with the physiological reality that our palms sweat and our heart rate spikes when we look at a chart.
The body still reacts.
Exactly. If the market isn't causing our fear, what is? What is actually happening in our brains? The answer lies in how our minds process memories and associate them with the present moment.
This is where we have to look at the mechanics of perception. We have to understand that our memories, our acquired distinctions, and our deep-seated beliefs are not just abstract, cloudy ideas floating around in our heads. They exist in our minds as tangible, structured energy. And this structured energy acts as a literal filter on our senses, dictating exactly what we can and cannot perceive in our external environment.
The concept of structured energy can sound a bit abstract. Let's ground it. The perfect example from the source is the first time you ever look at a price chart. Imagine you've never traded before. You open an app on your phone, you pull up a stock chart, and what do your eyes actually see?
If you have no prior knowledge, you just see a bunch of meaningless, jagged lines going up and down. It is just undifferentiated sensory information. Your brain has no structured energy regarding charts, so it can't derive any meaning from it.
But then you take a course, you read a book, you learn about a technical pattern, let's say the concept of support. You learn that when the price line hits a certain bottom threshold repeatedly and bounces back up, that forms a floor, and it's a high probability opportunity to buy.
Right.
Now, a month later, if I show you that exact same jagged chart again, what do you see?
You instantly see the opportunity. You see the invisible support line holding the price up.
But the chart on the screen didn't change. It's the exact same image. The only thing that changed was the structured energy inside your mind.
Think of it like putting on a pair of heavily tinted sunglasses. The knowledge you acquired acted as a filter on your vision, causing you to recognize distinctions and opportunities that were literally invisible to you before. We only see what we have learned to see. The energy inside us defines the reality outside us.
And the terrifying part is that this doesn't just apply to positive knowledge like finding opportunities. It applies equally, if not more powerfully, to what we are afraid of. Our fears act as heavily tinted sunglasses, too.
They absolutely do.
Which brings us to arguably the most important and illustrative metaphor in the entire text, the boy and the dog. I want to spend significant time on this because if you, the listener, understand this one concept, it explains almost every self-sabotaging behavior you've ever had in trading or just in life.
It is a profound analogy that perfectly deconstructs how human beings project their internal emotional pain onto neutral information in the present moment. Let's walk through it step by step.
Set the scene for us.
Imagine a young child, maybe a toddler, who has never encountered a dog in his entire life. His mental environment regarding dogs is a completely clean slate. There's no structured energy there. One day, he is playing in the park, and he sees a dog for the first time.
Okay, total innocence.
Because he has no preconceived notions, no past memories to draw from, his natural, innate human instinct is curiosity. He wants to explore the unknown.
He's just a little learning machine. He reaches out to pet it.
Right. But unfortunately, this specific dog happens to be hostile. As the boy reaches his hand out, the dog snarls, lunges, and violently bites him. This is a severe physical and emotional trauma.
So in a fraction of a second, the clean slate is gone.
It is completely wiped out. The child has now acquired a memory, a distinction about the nature of dogs in the universe. And crucially, that memory is intensely charged with negative emotional energy. The concept of dog is now inextricably linked to fear, pain, and terror in the child's nervous system.
Okay. The trauma is locked in. Now fast forward a few months. The physical wound has healed. The child is walking down a different street in a different neighborhood, and he encounters a second dog. But this dog is completely different from the first one. This dog is a golden retriever, wagging its tail, panting happily, and it just wants to play. What happens to the child?
This is where the neurology takes over. The child's mind performs an instantaneous, involuntary association. Our brains are hardwired for survival, and the primary way they keep us safe is by linking anything in our external environment that shares similar characteristics with a past memory in our internal environment.
So the boy's eyes see the shape of the dog, his ears hear the panting, and instantly, before he can even form a conscious thought, his brain links this new sensory input with the highly charged, painful memory of the first dog.
Yes. His nervous system hits the panic button, his body is immediately flooded with adrenaline and terror, and here's the crucial, tragic part, the psychological mechanism called projection.
Projection.
The boy takes the pain and fear he is feeling inside his own body and projects it outward like a movie projector onto the friendly dog standing in front of him.
So from the boy's perspective, what is he actually seeing?
From his subjective perspective, this new friendly golden retriever is a terrifying, dangerous monster.
Yeah.
He cannot perceive the dog's playfulness. It is literally invisible to him. The dog is objectively safe, but the boy's mind is generating a reality of absolute danger.
That is heartbreaking, but it makes so much sense. So how does this translate to the adult listener who is staring at a trading screen or looking at a new business deal or even just dealing with a new relationship?
This is exactly what happens to a trader after a painful loss. It is the exact same neurological projection. Let's say you have a trading system that you've backtested and you know it works. But over the last week, you've hit a string of bad luck. You've had 3 losing trades in a row, you are hurting, you've lost money, and your ego is bruised.
My internal environment is charged with negative energy.
Exactly. Now, you open your chart today, and your system gives you a perfectly valid, mathematically sound signal to enter a new trade. The setup is flawless.
This new trade is the equivalent of the friendly, playful, golden retriever.
Precisely. The market is flashing a completely neutral signal that a high probability opportunity exists right now. But because your last few trades caused you pain, your mind bypasses logic. It instantaneously associates the characteristics of this now moment opportunity with the pain of your past losses. You take the fear and hesitation you feel inside and you project it onto the neutral chart.
And suddenly, this perfectly good trade looks insanely risky.
You perceive it as a massive threat to your safety. You hesitate. You start scrambling, looking for irrelevant news articles or obscure indicators to talk yourself out of taking the trade. You rationalize walking away. And then, well, you sit there and watch the market move exactly in the direction you originally predicted, but you were paralyzed. The opportunity was invisible to you because you were blinded by your own projected fear.
And the terrifying thing is that the reverse is true too, isn't it? Projection works with positive energy as well. If my last 3 trades were absolute home runs and I made a ton of money, my mind associates the now moment with euphoria.
Oh, absolutely.
I project that feeling of invincibility onto the chart, making me perceive the next trade as an absolute sure thing with zero risk.
Yes, which is arguably even more dangerous because it leads to total recklessness. You feel so confident that you over-leverage your account, you trade entirely too big, and you ignore your stop-loss rules because you just know it's going to work. In both cases, paralyzing fear and reckless euphoria, you are not seeing what the market is actually doing. You're not seeing the reality of the moment. You are just seeing your own mental state reflected back at you like a mirror.
That is just wow. It makes you question every single gut instinct you have when you are looking at an opportunity. If our brains are biologically hardwired to do this, to constantly project past pain or past euphoria onto the present moment to keep us safe, how do we ever break the cycle? If my own brain is sabotaging my perception, how do I stop it?
If you want to stop projecting the dog, you have to install an entirely new operating system in your mind. You cannot rely on your natural instincts. You have to develop what the source calls a probabilistic mindset. You have to fundamentally rewire how you think about certainty and start thinking like a casino.
Okay, becoming the casino. And to be clear, we don't mean acting like the gambler who walks into the casino. We mean adopting the mindset of the casino itself,
Yeah,
the house.
exactly. Think about how a casino operates. Let's use a roulette table as an example. The casino knows that any individual spin of that roulette wheel is completely random. The ball could land anywhere. Does the casino management care about the outcome of one specific spin?
No,
Do the pit bosses break into a cold sweat and start crying in the corner if a player walks up, bets $100,000 on Black 22, and wins a massive payout?
definitely not. They politely pay the person, smile, and spin the wheel again.
Why are they so calm when they just lost a fortune on a single spin? Because the casino doesn't need to predict the outcome of any single event to make money. They know that the game is structured with a built-in statistical edge in their favor. They know that over a large enough sample size, 1,000 spins, 10,000 spins, that mathematical edge guarantees them a profit. They're completely, totally unattached to the outcome of the individual unique event, but they are supremely confident in the overall probabilities.
They know that losing a hand is just a normal business expense on the way to long-term profitability. So to trade like that, to live life with that level of unshakable confidence in the face of uncertainty, the source material says we have to deeply internalize 5 fundamental truths.
Yes, the 5 truths.
And when we say internalize, we don't just mean agreeing with them intellectually. We mean believing them at the core of your being so deeply that they override your natural neurological urge to project fear. Let's dedicate some serious time to unpacking these 5 truths, because they are the foundation of this entire psychological shift.
Let's start with truth number 1. And it sounds almost overly simple at first. Anything can happen.
It does sound simple. Of course, anything can happen. But here's where it gets really interesting when you dig into it. We all say we know anything can happen, but our actions show we don't actually believe it. When we see a chart pattern that has worked the last 5 times, our brain secretly convinces us that we know exactly what is going to happen next. We become certain.
And that certainty is the trap. You have to realize that there are unknown variables operating in every market at all times, no matter how perfect your analysis is. We talked about the rogue billionaire earlier. It only takes one person, anywhere in the world, with a different belief about the future and enough capital to act on it to completely blow up your perfectly crafted setup.
One person can negate all my hard work.
Yes. And if you truly deeply believe that anything can happen, then you realize that having rigid expectations about the future is completely irrational. If you don't expect the market to behave exactly as you want it to, then there is no shock, no sense of betrayal, and no emotional pain when the market inevitably does something unexpected. Accepting that anything can happen neutralizes the threat of being wrong.
That leads directly into truth number 2. You don't need to know what is going to happen next to make money.
This truth is the ultimate antidote to the black hole of analysis. Remember the traders studying 20 different indicators trying to predict the future. This truth sets them free. You don't need to be a fortune teller. You don't need a crystal ball. You don't need to predict the next tick of the market. All you need is an edge and the rigid discipline to execute that edge repeatedly.
Like the casino.
Exactly. The casino doesn't know what the next card out of the shoe will be, but they still make billions of dollars a year. You have to let go of the need to be a prophet.
Which brings us to truth number 3. And this one directly attacks how our brains misinterpret patterns. There is a random distribution between wins and losses for any given set of variables that defines an edge.
The coin flip analogy is the absolute best way to visualize this. Imagine you have a loaded coin. It's weighted perfectly so that it lands on heads 70% of the time. In the world trading, a 70% win rate is an incredibly massive edge. You're basically printing money.
Right, if I know it hits heads 70% of the time, I'm betting my house on heads.
But here is where the human brain fails at probability. You start flipping the coin. Flip 1, tails. Flip 2, tails. Flip 3, tails. You just lost 3 times in a row with a 70% edge. Now, you are holding the coin for the 4th flip. What are the odds that it lands on heads this time?
Logically, mathematically, the odds are still exactly 70%. The coin has no memory of the last 3 flips. But human nature, what we call the gambler's fallacy, makes our brain scream, well, I've had 3 tails in a row, so a heads is absolutely definitely due to happen now. I'm going to double my bet.
Or the opposite happens.
Right. Or, conversely, the fear projection kicks in, and the brain says, I've lost 3 times in a row, this coin is broken, I'm terrified to bet on the next flip, I'm going to pass.
You hit the nail on the head. We desperately want to connect the current event to the past events. But a losing streak does not mean a win is magically due, and a winning streak doesn't guarantee the next trade will work. The outcomes of individual trades are statistically independent. The 70% edge only reveals itself over a large sample size of flips.
Over the long term.
Exactly. If you truly believe this truth, you stop associating the current trade with the emotional outcome of the last trade. You stop projecting the trauma of the dog onto the current moment.
You treat every flip as an independent event. Truth number 4 builds on that. An edge is nothing more than an indication of a higher probability of one thing happening over another.
We have to deconstruct the word edge. When amateurs hear they have an edge, they subconsciously translate that word to mean guarantee. They think an edge means they are right. But an edge is just a slight lean in the mathematical odds. It's 51% versus 49%.
It's a probability, not a certainty.
Exactly. If you view an edge as a guarantee, you will be emotionally crushed and feel betrayed every single time it fails. But if you view it as nothing more than a slightly higher probability, then a failure is just a normal, expected, completely boring part of doing business. You expect losses to happen as part of the probability distribution.
And finally, truth number 5, which is perhaps the hardest for pattern-seeking humans to accept, every moment in the market is unique.
This attacks the very foundation of why technical analysis tricks us. You could look at a chart today, and the pattern might look exactly, pixel for pixel, identical to a pattern you traded successfully last month. Your brain says, I know this pattern. I know how this ends.
Because it looks exactly the same.
It looks the same, but the underlying components are entirely different. The actual, literal human beings participating in the market at this exact second are different from the people who were participating last month. Different people with different beliefs, different bank accounts, and different motives are pushing the buttons. Therefore, the moment is completely unique in human history. Assuming you know what will happen because the picture looks like the past is a fatal trap.
Wait, hold on. Let me step into the listener's shoes for a second, because I'm listening to these five truths and my brain is actively resisting. You are telling me I have to operate in a constant state of accepting that I never truly know what's going to happen, that every moment is uniquely unpredictable, and that anything can go wrong at any time. Isn't that exhausting?
It sounds like it would be.
Yeah, living in a constant state of uncertainty sounds like a recipe for chronic anxiety.
It's completely counterintuitive, isn't it? It seems like accepting total uncertainty would be exhausting and terrifying. But in reality, it is the exact opposite. It is completely, profoundly liberating.
How is not knowing the future liberating?
Think about what actually causes anxiety in your life. Anxiety isn't caused by the unknown itself. Anxiety is caused by trying to control something you cannot possibly control, and then agonizing over the consequences of failing to control it. You are anxious because you're desperately trying to be right in an environment that doesn't care about your opinion.
It's the constant fear of being wrong that exhausts us.
Yes. But if you genuinely, deeply accept the five truths, if you accept that you don't know what is going to happen next and that anything can happen and that every moment is unique, well, how can the market ever make you wrong? The concept of being wrong ceases to exist. If you don't expect to be right in the first place, there's absolutely no emotional pain when the market goes against you.
Because you fully expected that it might go against you. It was factored into the probability.
You eliminate the threat of emotional pain entirely. When the subconscious threat of pain is gone, the fear disappears. And when the fear disappears, your mind becomes clear. You stop projecting past traumas. You can effortlessly enter what Douglas calls the zone, acting purely on what the market is telling you in the present moment, without hesitation, without overanalysis, and without agonizing regret.
That is a massive paradigm shift. It's not about forcing yourself to tolerate the immense pain of being wrong. It's about shifting your foundational beliefs so that the very concept of being wrong is removed from your psychological vocabulary.
It is a state of mind where you are completely peacefully detached from the outcome of any single event while remaining supremely confident in your long-term execution.
Okay, this brings us to the final hurdle. We've talked a lot of theory. We understand the psychology of the wilderness. We understand how projection works with the boy and the dog, and we intellectually agree with the five truths. But as we established earlier, understanding something logically and believing it at your core when your hard-earned money is on the line are two entirely different universes.
Completely different.
How do we put this into practice? How do we move from the intellectual stage of nodding along to a deep dive like this to what the source calls the mechanical stage of actual execution?
To bridge that massive gap between intellect and action, you have to physically train your mind. You can't just think your way into a new belief system, you have to act your way into it. You have to prove to your primitive brain that trading really is just a simple numbers game, like pulling the handle on a slot machine. And to do that, the source material provides a very specific, highly rigid mechanical exercise. It's called the 20-trade exercise.
I love this part because it takes all the lofty psychological theory and gives you, the listener, something incredibly tangible and actionable to do. It's essentially a boot camp for reprogramming the subconscious mind. Walk us through the mechanics of the exercise.
The setup sounds simple, but the emotional execution of it is incredibly difficult for most people. First, you choose one single market to trade. You don't jump around. Second, you pick one specific, highly rigid set of variables that defines your edge. It can be a simple moving average crossover, it could be a specific breakout pattern, whatever. It honestly doesn't even have to be a brilliant, world-class system.
Right, I think that's a crucial point. The goal of this specific exercise isn't to make $1 million or prove you are a genius market analyst.
Not at all. The sole goal of the exercise is flawless, emotionless execution. Once you define your variables, the rules are absolute. There can be absolutely no subjective decision-making. If your specific variables align on the chart, you take the trade, period. You do not second-guess it. You do not check the financial news. You do not ask your friend for their opinion. You do not look at other indicators to confirm it. You must commit to taking the next 20 consecutive trades that fit your exact parameters.
You are forcing yourself to become the casino floor worker, just spinning the wheel. But the most critical part of this exercise, the part where I guarantee everyone's psychology starts screaming at them, is the rule about accepting the risk in advance.
This is where the rubber meets the road. Before you even enter the trade, before you click buy, you must define exactly what your stop loss is. You're determining the exact, specific, monetary cost to find out if this specific trade is going to work. You are pushing your chips onto the blackjack table. And once you place that stop loss, you cannot move it. You cannot widen it to give the trade more room to breathe because you are afraid of taking the loss.
Let me play the skeptic here because this raises a really practical fear. What if the basic system you chose for this exercise is just flawed? What if you are faithfully executing the 20 trade exercise and you lose trade number 1, then trade number 2, and suddenly you are on trade number 7 and you've lost every single time? Losing 20 trades in a row could be financially devastating.
And that very real, very logical fear is exactly what will cause you to break the rules of the exercise if you aren't careful. If you are afraid of the financial ruin, your brain will revert to projection. You will see the dog. On trade number 8, you will hesitate. You will skip the trade because you are terrified and you will have failed the exercise.
So how do you mitigate that?
This is why it is heavily emphasized that you must radically scale down your position size for this exercise. You must trade a size so incredibly small, we are talking risking micro amounts, or even using a simulated trading account with fake money, that you are completely 100% financially and emotionally comfortable with the absolute worst case scenario. You must be at peace with the idea of losing all 20 trades in a row.
Because if you are even slightly terrified of losing the money on trade number 4, your pain avoidance mechanisms will automatically kick in. You will start rationalizing why this specific setup doesn't look quite right. You will hesitate or you will skip the trade, and the whole mechanism of building trust is ruined.
Exactly. If the risk isn't truly completely accepted in advance, the exercise will not work. You will just be repeating your old habits. I cannot stress this enough. The ultimate goal of this 20 trade sample is not to see if your system generates a profit. It is purely about proving to yourself that you can execute a plan flawlessly without fear, without hesitation, and without getting euphoric when you win.
You are building self-trust. You are proving to your own subconscious mind that you have the discipline to create your own internal structure and stick to your own rules in an environment that provides absolutely zero boundaries to save you.
You are becoming the structure. When you can complete the entire 20 trade sample without a single internal argument, without feeling the physical need to control the outcome, without your heart rate spiking when the trade goes against you, you have functionally installed the 5 fundamental truths. You have shifted from a fearful projecting mind to a probabilistic mind. You have acquired a true trader's mindset.
Wow. We have covered an immense amount of psychological ground here today. Let's gracefully recap this journey we've been on, because there is a lot to digest. We started by looking at the great paradox why incredibly smart, successful people fail in the markets. And we found it's because they fall into the black hole of analysis, falsely believing that gathering more data will act as an armor against the emotional pain of being wrong.
From there, we explored the psychological danger of the boundaryless market. We saw how the lack of rules allows us to become passive losers, letting bad decisions bleed us dry because we refuse to actively accept a loss. And we saw how the casino-like environment of random rewards hijacks our dopamine systems, making us addicted to undisciplined gambling rather than structured execution.
We dove deep into the neurology of perception, using the analogy of the boy and the dog to understand how our brains act like a movie projector. We take the negatively charged energy of past traumas and project it onto perfectly safe, neutral opportunities in the present moment, blinding us to reality.
And to stop that projection, we outlined the absolute necessity of adopting the 5 truths of a probabilistic mindset, fully accepting that anything can happen, that we don't need to know the future to succeed, that probabilities are randomly distributed, and that every single moment is entirely unique.
And finally, we discussed the mechanical 20-trade exercise, the boot camp required to physically retrain the brain to trust itself and execute without fear.
It is nothing less than a complete teardown and rebuild of how a human being interacts with uncertainty.
And here's why this matters to you, the listener. Even if you never open a brokerage account or trade a single share of stock in your entire life, think about how these concepts apply to your everyday reality. Whether you are an entrepreneur deciding to launch a new product, a manager leading a team through a crisis, someone navigating a major career change, or just a person trying to build a healthy relationship in an unpredictable world, trying to perfectly predict and control the future is a trap. It is a psychological trap driven purely by the fear of being wrong and the fear of getting hurt.
True confidence doesn't come from gathering enough data to know exactly what is going to happen next. That kind of certainty is an illusion.
True confidence comes from trusting yourself. It comes from knowing that whatever the unpredictable world throws at you, you have the internal structure, the discipline, and the emotional detachment to execute your plan and adapt to the reality of the moment.
That is the essence of mastering the zone. And as we wrap up this deep dive, I want to leave you with a final thought to really mull over, building on the core metaphor we discussed earlier.
The boy and the dog.
Yes. Think about your daily life outside of the financial markets. Think about your current relationships, your career trajectory, your personal goals, or even the small conflicts you face every week. Look closely at the people, the opportunities, or the challenges standing right in front of you today. How many of them are you misjudging right now, simply because you are unconsciously projecting the negatively charged energy of a past trauma onto a completely unique now moment? Ask yourself honestly, are you running away from a friendly dog today just because you were bitten in the past?
That is a profound question worth sitting with. Thank you for joining us on this deep dive into the source material. We'll see you next time.